All right, today we're going to look at a trading strategy that's so simple, you could probably learn it in the next minute. But you're going to want to stick around because we're also going to uncover the real secret, the thing that truly separates the traders who make it from everyone else. So let's dive in. If you're looking for a clear, simple way to find trades during the day, I get it. The market can feel like just a wall of noise. And that's exactly why a strategy called the open high, open low is so popular. It's all about its beautiful simplicity. So what is this thing? Well, at its heart, it's incredibly straightforward. It's a technique for day trading that zeroes in on one single moment, the market open. The whole idea is built around what that first price tells us about who's in control, the buyers or the sellers, right from the get-go. Okay, so how does it actually work? Well, it spits out two really clear signals. First, you've got your bullish signal. This happens when a stock's opening price is also its lowest price for the day. It's a hint that buyers were so aggressive that the price never even got a chance to dip. And on the flip side, you've got the bearish signal. This is when the open price is the highest price of the day, which suggests sellers were in complete control from the moment the bell rang. See? Simple, right? So you've got a clear signal, a simple rule to follow. This seems like the key to trading, doesn't it? Just find a good system, follow the rules, and the profits will come. But this is where the real lesson starts. Is having a strategy, even a really good one, actually the most important piece of the puzzle? The answer might not be what you think. And boom, there it is. This quote just flips the whole idea of what's important right on its head. The strategy, the signal, that perfect entry point you're always looking for, that's only 20% of the game. The real battle, the other 80%, is fought somewhere else entirely. I mean, just look at this breakdown. 80%. That massive slice of the pie is all about how you manage your money and maybe even more critically, how you manage your own mind. The what and where to buy or sell, that's the small part. The how much you risk and why you're making your decisions, that's the whole ballgame. So for the rest of this explainer, we're going to focus on that huge, crucial 80%. So let's start with the first half of that 80%, money management. Specifically, how you decide on the size of your position for any given trade. I'm telling you, this is arguably the single most important skill any trader can ever learn. To really get why this matters so much, let's use an analogy. Imagine you sit down at a poker table with 1,000 rupees. First hand, you bet 200 and you lose. Second hand, you bet another 200 and you lose again. Now you're frustrated and you think, I've got to win it all back. So you shove your last 600 in on the third hand and you're wiped out. Gone in 10 minutes. Now, was the problem bad luck? Not really. It was terrible bet sizing. Risking 20 to 60% of your capital on a single hand is a guaranteed recipe for disaster. And trading is absolutely no different. And if that doesn't convince you, just look at the brutal math of losing on this slide. It's called recovery trauma, and well, it's a little terrifying. Look here, a 10% loss requires an 11% gain just to get back to even. Okay, that seems manageable, but just follow that column down. A 50% loss requires a 100% gain just to get back to where you started. The math is just unforgiving. That's why protecting your capital isn't just important, it's job number one. Okay, so how do you do this properly? Here's a dead simple 3-step process. First, you decide on your maximum risk for any single trade. Let's say 1.5% of your total capital. That number is sacred. Second, you calculate the risk of the specific trade in rupees. That's just the distance between your entry price and your stop loss, the point where you get out if you're wrong. And finally, you just divide your max risk from step 1 by your trade risk from step 2. That simple calculation tells you exactly how many shares to buy. It makes sure any single loss is always small and totally survivable. Okay, so we've covered money management. Now let's move to the other part of that big 80%, mind management, or, trading psychology. Because once you've learned how to protect your capital, the biggest risk left in the market is you. See, our brains have all these little mental shortcuts they use to get through the day. But in the world of trading, those shortcuts can be incredibly expensive. One of the most famous ones is called anchoring bias. This is our tendency to just latch on to the very first piece of information we get, like a price, and use it as a fixed anchor for every decision we make after that, even if that anchor is completely random. It's a mental trap, and boy is it a costly one. And to show you just how damaging this can be, the source material shares this really powerful personal story. It's about a massive investment opportunity, a moment that really could have been life-changing that was completely missed all because of an anchor, a single arbitrary number that got stuck in the mind.
So here's the story. Back in 2013, the author had identified a stock, Sundaram Clayton, as a great buy. The price was around 270 rupees. And that number, 270, became the anchor. He decided he would only buy it at 270 or lower. So the stock moved up to 280, then 290, but he was stuck on his anchor. He wasn't going to pay a premium. Well, as you can see on the right, the stock never came back. Instead, it just took off on this phenomenal run. A huge opportunity lost. Not because the analysis was wrong. The analysis was perfect. It was lost because of a psychological fixation on one number.
So let's bring all this home. We started with a simple strategy, but as we've seen, the real secret to success isn't about finding the perfect signal. It's about building a solid, disciplined system that can handle losses and protect you from your own mental mistakes. So what's the foundation of a successful trader really look like? Well, first, a strategy is just a tool, not the whole toolbox. Second, your primary job isn't to make money, it's to protect your capital, above all else. Third, you've got to realize your own biases can be your biggest risk. And finally, and this is the big one, long-term success is not found in some secret formula. It is forged in discipline. And that really leaves us with one final question to think about. As you continue your own journey, what are you spending most of your time on? Are you endlessly hunting for that one holy grail strategy, or are you focused on building the unshakable discipline that truly matters in the long run? The answer to that question will define your journey. Thanks for joining me.